Hello and good afternoon in my case. It's Friday, the 3rd of August 2018. It's an interesting day because today, in around 1.5 hours from now, we have the non-farm payrolls, which we want to have a look at, even though this webinar aims to give an overview of the upcoming trading week and which trading chances could arise here in the FX, but also in the equity and also in the commodities market. And yes, so my name is Jens Klatt, and within the next 45 minutes, I hope that I can give some valuable insights into my thoughts here. If you have any questions, please feel free to ask them in the chat box, and also on markets, which might be of interest for you, by the way. So if you say, "Hey, I'm an investor," yes, investor, why not? A carry trader, let's call it. And I'm focusing on NZD-JPY, for example. What's your outlook on this currency pair? Just shoot it over and we have a look, even though it's a very exotic currency pair, and I have to surely think about it for quite some seconds to get something together. And yeah, before we start, as usual, let's have a look here at the risk disclaimer. Oh, that was a little too quick. Again, the risk disclaimer, please make sure that you understand that trading with financial instruments offered by Admiral Markets, CFDs, ETFs, stocks, that these products carry a high level of risk, and this could be that it's not suitable for you as an investor due to their complex nature. Before entering into any agreement or transaction, please read the terms and conditions of the service from Admiral Markets. Consult a specialist if necessary to ensure that you understand the risks involved in trading, and also make sure that investors that you study carefully the key information documents, the so-called KID, in order to understand the nature, risks, costs, potential gains and losses of margin product offered by Admiral Markets. The question, why Admiral Markets? Well, in fact, it's here in Germany, Admiral Markets is known as the DAX specialist, offering typical spreads, for example, of 0.8 points during the main trading hours. So being very, very low in terms of commission. But this is not only true for the DAX, but also for other assets. So check out the website, admiralmarkets.com, for further information. And also feel free to contact Admiral Markets directly via phone, for example. This week has been under one topic in general, the so-called ESMA regulation. There have been important changes for Forex and CFD trading, especially leveraged restrictions. This is the main focus here around the ESMA decision. For retail clients, there's a maximum now of 1 to 30 for Forex majors, for example, if you're trading Euro USD, for example, but also 1 to 20 for other currency pairs, so-called minor currency pairs. One which I'd like to emphasize here, it's the GBP CAD. Why GBP CAD? Well, we want to have a look at this currency pair since from next week onwards, it could get really interesting, especially now after the Bank of England decided to hike rates and pound sterling did not take off as expected. So here, make sure that you see that as a retail client, if you haven't taken the step to professionalize yourself, that here you as a retail client now have a leverage of 1 to 20. The same is true for CFDs on indices or also gold. So for the DAX, for example, for further information, feel free to reach out to Admiral Markets. There, by the way, also you can ask your questions around the negative balance protection, which is also true for professional clients up to 50,000 GBP according to the policy of Admiral Markets. So that could be really interesting. Why do I mention this professional client stuff? Very simple, in fact, because a professional client here is not affected by the leverage restrictions. So meaning that everything stays the same for you in terms of leverage if you professionalize yourself. Nevertheless, there is something to take into account. For example, that's not unlimited protection, but up to 50,000 protection and so on. Again, for further information, feel free to reach out to Admiral Markets here. Contact Admiral via hello@Admiral Markets, for example, by phone, FCA regulation. You can see it here, London office, for example. So now that's me. And before we start, we also want to have a look at the agenda on what we want to focus today. So the questions we want to answer here are, what are the key economic events, for example, in the upcoming trading week? What's the current bias in the FX, equity, and commodity markets? So I have, in fact, the feeling that we are probably about to top out and get to see the beginning of a hot summer, let's say. And this has mainly to do with the fact that the numbers from Apple came in really good, and that Apple is about to become the first company in the world with a market cap of 1 trillion USD here. The only problem is that this limits further speculation, and I don't really see where positive triggers could come from to counter any doubts around the shadows at the horizon, let's call them, around the trade war escalation between the US and China, respectively between the US and the European Union. And then the question, which trading opportunities may arise? And we want, again, as I already mentioned here, have a look at the GBP CAD in this case. I think it's a very, very interesting currency pair right now, also from a seasonal perspective, not only from a technical and fundamental side. And on top of that, there's also, I think, quite interesting outlook for Euro USD. And we want to use the non-farm payrolls from today and then use this news event as a potential trigger. I mean, it surely depends on how the numbers come out, but probably also formulate an idea on Euro USD here, but also what and how the impact on the equity markets could be then. But let's first of all start here then now with a website I've already opened. In this case, it's not Admiral Markets as usual, but it's Apple. It's Market Watch, and it's the share of Apple here. And what I want to underline here with that is that we want to have a look here at this left column and see that the market cap is obviously short of, it's only, and this is funny, I mean, we're talking about only 27 billion, but it could easily be achieved here. Look at the price per share in this context. So with the outstanding shares, this market cap could easily be reached. And yeah, again, the numbers presented from Apple were outstanding once again, exploding in terms of the, let's call it a luxury product with the new iPhone. Why do I look at this share? Because I'm, again and again, really fascinated about this this rally, which started already here. So this is the most data we can get. It started out at 2002 here, in fact, when Apple was trading at, let me just, that was around $1, right? That was shortly after the new economy bust. That was 165. But however, the reason I mentioned this is the following. I thought about buying some Apple, which I in fact didn't, and I regret it. I want to be honest. I thought about buying it after reading a quite simple interview with a hedge fund manager who said, well, we are currently planning to extend our exposure, our long exposure in Apple shares based on the fact that Apple hasn't yet conquered the Chinese market. I mean, that was a very simple idea, in fact, but I thought about it a while, and I thought, well, it's probably a good idea. And when I first came across this this thought and this interview, that was at the beginning of, I think it was 2012. So, but Apple shares had already rallied up to around 100 USD from here. So it is probably somewhere around here. So in the region around, probably 60, 70, 80, probably it was 100. But however you put it, it was quite, let's call it, extended on the upside. And there were several reasons why I had doubts to buy the share back then, because also there was some serious problems still brewing, and some of those problems already came to the surface around the European Union and the Euro crisis back then. And I wasn't really positive for the equity markets in general, especially not if I'm planning to buy physical stocks in this case, but this is also something offered by Admiral. You can trade physical stocks via the MT5. But let's come back to the Apple shares in this case. So I was really skeptical whether this is a good market environment. Was but was more like, let's wait for a bounce and then position yourself. Well, the bounce never came, let's put it that way. As you can see, it depends on whether I take 60 or 70 USD per share, or if I take 100, but it's somewhere in the range of it doubled to tripled since 2012, and I came across this thought around Apple shares. But now the thing is, I mean, I missed this trading opportunity, okay, or investment. It wouldn't have been a trade, but it would have been like, I buy the share and I put it in my portfolio, that's it. So I'm not actively trading it here from a physical stock perspective. But the thing is now, there's more and more doubts on my end, wondering how many positive numbers can come there. I mean, it's like, you have the feeling that the speculation starts to somehow find somewhere, or let's put it another way. There is a saying the sky is the limit. It seems as if Apple now reached the sky. That's how you could put it. And I don't really see where speculative interest could come from to aggressively keep on buying Apple shares here, especially also based on the fact that the QE. Sorry, that was the one I was missing. That the QE program came to an end here, and right now the Fed started to hike rates and find itself in a rate hike cycle. So now what I want to say is Apple was one of, or is the company in the world. It's from a market capitalization perspective here worthier than, for example, Amazon. It has a great business approach, and there's no question about it. But the thing is that I don't really see that there's further room on the upside for Apple. So Apple itself has a major impact, especially as you can see it here. This is the Apple shares are traded at the Nasdaq. It has a major impact on the performance of the Nasdaq, and we have seen plenty of cases. By the way, 1 second, please. Let me just. 1 second. Let me just. Okay. So this is the chart from Nasdaq, from the Nasdaq here. And so the interesting thing is that, as you can see, there were plenty of pullbacks last week. That was mainly due to the losses in Facebook, for example. And there were only Amazon and Apple which really were capable of holding the Nasdaq above this purple line here, the exponential moving average 50 in this case, which obviously acted as a support in the past already, as you can see it here. And by the way, I'm currently seeing that the euro is taking off, just wondering why. So you can see it here. There was a short position we have in euro Japanese yen, and currently the market is moving against us. And I'm just wondering, because non-farm payroll is about to be published in around an hour from now. It's obviously, it seems as if it's JPY weakness. Okay, but let's focus on this a little later on. So the thing is, you can see that we tested this level again and found support here. But now the question remains: do we have enough speculation on the upside that we will break to further highs from here, or is there probably a good reason to start to be skeptical? I mean, we have to say that this structure of higher highs and higher lows is in play as long, or the sequence of an uptrend here, or the uptrend in general, is in play as long as we trade above 6,950 points, so slightly below 7,000 points. And we are currently trading significantly below that level. I'm sorry, above that level. So there's no real need to be scared right now. Nevertheless, I think that now with the numbers around Amazon and Apple, while Facebook and Netflix, for example, fell short to deliver, and there was also Google, which was quite solid. But the thing is, and this is what I'm referring to here, is I don't really see that we can hold this structure here in the at least short term. And I have a strong feeling that we are about to top out, and that there is a high chance, especially in the next week, that there will be another push here on the downside. And after saying that, now we want to focus here on the DAX and what it could probably mean for the DAX then in this case. After we made it back above the simple moving average 200 here, we obviously failed to take on further momentum, but instead pushed significantly lower yesterday. So there was some, there was an angel, there was an invisible hand which was capable of holding Wall Street stable. And in fact, when looking at the chart on a 50-minute time frame here, you can see that yesterday our approach, the open range breakout approach here, worked out perfectly well once again, because there was, as you can see, nearly only green candles the whole day long. So there was no seller out there. There was only buyers, and demand was capable of absorbing supply the whole day long. And this bullish momentum here on the upside was the reason why the DAX could make back most of its losses here. Sorry. Oh, something went wrong. Let me just do it that way. Okay, it seems as if there's a small problem with the expert advisor here. Let me just... Okay, so for whatever reason, okay, so something went wrong here. However, so as you can see yesterday, let's come back to the day yesterday. That's completely fine, because we want to focus on the higher time frames here. So the DAX was capable of making back some of its losses from yesterday, from the first hours of trading, and that was mainly due to Wall Street finding quite strong demand here. And the question is still on the table: why? And where did we find that? Is it probably kind of a, let's call it an airball? To me, I'm not really convinced that this is a strong move, but it seems to be a weak one. And I wouldn't be surprised, probably especially if the non-farm payrolls do not surprise on the upside today, to see another push down towards 12,500 points into the weekly close. So I think we have a solid chance that we are not yet done on the downside. And if we drop again towards 12,500 points, and I somehow have the feeling that this is especially true if non-farm payrolls do not come in better than expected, plus Wall Street probably gives back some of its gains from yesterday, that then there's a serious chance that some of these current intraday gains here will be given back, and that we push back to week or not. All in all, we can say that if we push below 12,500, some might say we need to push below 12,400 points, that then we can definitely classify this move here as a potential fake out. And this would definitely level the path probably down to 12,000 and around, let's round this number up, 12,100 points. It's a key level. It's the region around the lows from June and July. If we break below that, next target is definitely the region around the yearly lows. Not sure whether this will really happen next week. Probably I'm a little too skeptical here, even though I think it's important to note that the moment the trade war fears escalate once again, for whatever reason, what we've heard so far is that the Chinese were willing to talk to Washington once again, but then there were also sources saying that so far those talks are not going in a straight and dynamic direction to solve the problem around the trade war, but they are quite, let's call it lethargic in this case. And the moment such an escalation takes place again, I think this is the moment where then real significant pressure from the upside should be expected, since so far the big players in the market, like Apple, like Amazon, are not capable of stabilizing the markets anymore. And this means that then there could be some serious pressure forming, which is then pushing us towards and below 12,400 points, and even lower than that, and down to 12,100 points here on the downside. This is probably then the most likely outcome in the next trading week. And if we push to this level, I think there's also a serious chance. Then sure, we have to find potentially another trigger. Probably this is also a trigger around trade war, which could trigger further bearish action. But all in all, I think that the chances are then quite high that a drop below the June-July highs could occur, and we go to the yearly lows here. When does the picture brighten up for the DAX? I think this is the case once we make it back above 12,900 points here on the upside. So this is the level to watch. So far, I have to say, yes, we trade still up above 12,400 points, which means there's still a chance. But after the losses yesterday, I start to get really, or I have doubts whether such a push here could happen within the next trading week, because I just do not see any positive trigger event which could drive the DAX higher here and make such an attack at the region around 12,900 points likely. With making it above that level, then pushing towards 13,000 to 13,200. Okay. So yeah, that's it around the DAX. Let's now move to the Euro USD and have a look here at the current picture, which is still neutral sideways, but nevertheless, especially after yesterday, in the last hours of trading, one had the feeling that the US dollar now can take on serious momentum, which pushed the Euro USD below 116 for short term. Now we can make it slightly back above that level. So it's not only that the Japanese yen here currently has some trouble, but obviously the euro can also obviously gain again for whatever reason. So what you can see is that we so far made it to new daily highs. Let me just probably double check here Twitter. What could be the reason for that? 1 second. Okay. Okay, that's interesting. So six minutes ago, there was the following: China to adjust forward foreign exchange risk reserve requirement ratio to 20%. That says the PBOC, the People's Bank of China. And also China Central Bank says it will take counter-cyclical measures to keep Forex markets stable based on market conditions. Short version of what just was announced here is it's nearly enough yuan weakness. What are we referring to here is the following. Have a look at this. So as you can see, from the moment trade war fears started, the yuan started to aggressively weaken against the US dollar, especially. And then it's not only that it's, in my opinion, a counter a measure of the People's Bank of China to counter positive, negative impacts of a trade war escalation here for the Chinese economy. But this is also now becoming a problem because it accelerates capital outflows of China, and this is something what the People's Bank of China obviously addresses here right in this moment with this announcement. And so based on that, currently market participants start to wonder whether probably the Chinese central bank starts to aggressively sell US dollars into such an announcement. This is the most likely outcome to stabilize the Chinese yuan here in this case. The only problem is that it's not only that here this is weakening the US dollar, but it's also, in case of the Japanese yen, and not necessarily a sign that the Japanese yen can profit from it, because it shows that there's a central bank now with much buying power and the capability to stabilize the market, stepping in and trying to act as an angel for the markets, let's say. And this is usually something which is not very positive for a currency like the Japanese yen, which is usually used as a finance vehicle for risk-on trades, but the complete opposite. So usually you start now to sell Japanese yen, to lend Japanese yen, selling it, and then buy, in this case, high yield assets or high yield currencies with this money. So this means usually that the US dollar, on the one hand, is expected to weaken, for example, against a currency like GBP or euro, but it's more likely to present itself stable against the Japanese yen. And this is perfectly illustrating what's happening right now here with this trade. So because if Euro USD is shooting up, while USD Japanese yen is stabilizing or drifting higher, well, Euro is obviously gaining against Japanese yen. So it's not really positive, but it's only a short-term reaction. So let's see whether we get stopped out or not. The thing is, that's a systematic based trade based on an Asia breakout system. You can, one second, see it here. Let's just see whether we really break out of this range here on the upside or not. If we do, fine. I'm fine with that, since the risk is bent to nearly 1% of this trade. So I'm completely fine if we break out here, even though I surely appreciate it to see a break lower here in this case. So that's it around this current development here. But this is nothing more, in my opinion, than noise currently, because the main drivers will be the, this is what we will have a look at a little later on. The main driver is definitely the non-farm payrolls then at the end of the week. So today, at the end of the week today. And so let's get a quick overview in the economic calendar here on the website from Admiral Markets. What to expect. So Friday, 3rd of August. So non-farm payrolls are expected to come in at 190,000. So this is an estimate from analysts. To make long things short, I think that the moment the numbers come in better than expected, which means usually a number around 200,000 and higher. So everything above 210,000, I think very positive. If we get an unemployment rate at 3.9, and also a number which is not displayed here, but also very important to watch that is the so-called average hourly earnings. Average hourly earnings, if they come in also above or around expectation, 0.3 month on month, respectively 0.4, probably above expectation, this could be a sign that the US dollar will continue with its short-term strength it has already shown into yesterday's trading close then. So with this in mind, chances increase, and therefore I've prepared the following here, a website called Bar Chart. And if you click on barchart.com, if you click on futures, and there you have the commitment of traders report. So it's a very great tool here to see how are the big speculators positioned. So if we now go here down to the currencies and the US dollar index future, you can spot something really interesting. So we are around to trade to respectively break above. Oh, I'm sorry, that's corn. I have to click on this one here. Yeah, that's better. So it's very interesting to see here that this is a crucial resistance region, and we're currently trading around 95, 95.30. And big speculators, they are moderately long positioned, even though it's the highest long position since 18 months. And saying that, it means that if numbers around non-farm payrolls today come in better than expected, probably significantly, let's wait for this. I'm not sure whether this will really happen, but probably there's a slim chance that this will happen. If it happens, there could be a significant push higher. This is then also leveling the path up to 97.50 to 98, I'm sorry, on the upside. And if this really happens, if this push happens, and US dollar buyers aggressively pour into the market, things start to get really interesting, because what we also know is that here the US dollar index, the basket, it consists to 58% of euro, meaning if we get to see such a push higher, this should naturally go hand in hand with a push lower in the, okay, now the trade was stopped out, Euro Japanese yen, as you can see here. It should naturally push lower, and we should go down to probably 112, because, and this is very simple, I see this as a trigger line around 115. So probably we don't get to see the trade down to 115 today, or probably we trade down to 115, but we don't necessarily get the break of this level to see here. And the moment we break below that, the next projected target on the downside can be found around 112 around, because we just say 115 on the downside, 118 on the upside. This is 300 pips. We duplicate this range, and the first projected target can be found at 112. Not necessarily said that we will reach this level next week, but if we start to break below that level, chances are good that here we start to trade lower than in the upcoming week, and the advantage on an intraday, or from an intraday perspective, for most of the trading week next week can be found on the short side, and this is the side to favor them. So yeah, that's it around the Euro USD and the non-farm payrolls upcoming in around 1 hour from now. We now want also have a look here at pound sterling, which traded towards 130 and slightly below that level, I think, today. Yes, so we traded as low as 129.75, so pushed below that level. And the interesting thing is that yesterday there was also, oh, that's interesting. Okay. That yesterday there was also a very interesting rate decision. In fact, so I'm sorry, I just skipped one rate decision this week, one from the Fed, which was, in my opinion, not giving any further information at all, since the Fed held rates unchanged. The only thing which was probably of interest was that it said that the economic growth rate is still strong, and it further expects further gradual rate increases, but it wasn't really capable of pushing the US dollar right at this moment, even though some might say, but yesterday, the day after the Fed, obviously the US dollar gained momentum. So probably that was kind of a delayed reaction. Not sure whether this is really the case. But I think the more interesting rate decision was the Bank of England yesterday, and the reaction especially. So I was saying last week, on last Friday, I was saying I expect a dovish hike. And this is something where this means nothing more than they hike rates, yes, and they did in fact. But, and this is now the thing, after hiking rates, now they will, based on the Brexit negotiations and the lethargic negotiations here, they will step back from further rate hikes in the near term, or in the upcoming 6 months, because they just don't know in which direction a Brexit and the negotiations, and whether it will be a soft or a hard Brexit, how potential trade decisions could look like with the European Union and all this, how this will affect the UK economy. And with this uncertainty, they would probably say we hike once now because we think it's fine, because our economy is strong enough to cope with such a 25 basis point hike. Nevertheless, we do not want to hike or give a clear outlook on what will happen next, which is then considered a so-called dovish hike. Now, the interesting thing is pound sterling sold off yesterday after the hike. You can see it here within this candle. Okay, so we came in the trading day at 130.120, and we closed the day around 130, so nearly 1 cent lower. And now one might say, when only looking at the chart, okay, yes, they hiked rates, but it was in fact a dovish hike, but it was the complete opposite. So in my opinion, it wasn't a dovish hike at all, but it was a quite hawkish one. Nevertheless, pound sterling lost ground, which is an even weaker sign for the pound sterling in the upcoming days. So what happened was There was an anonymous vote of 9-0 in the Monetary Policy Committee, so in short, it's MPC, to raise rates to 0.75%. And it was not only that, but the MPC also agreed that more rate hikes will be needed. And they also added that there's a very limited slack in UK economy and that the labor market conditions are tightening, which is in fact quite positive and quite hawkish, in fact. So with said that, chances are, in my opinion, very good that probably in the upcoming months, probably till December, there will be another rate hike. Nevertheless, pound sterling sold off to this news, which is, again, a very, very weak sign, a probably even weaker one as the one which has, well, would have been sent when seeing a dovish hike. And with this in mind, I think the situation here for this seasonal trade in GBP CAD becomes even more interesting. I've already made this a topic several days before now, and I want to bring this up here once again. So very interesting to see there has been already a break below the lows from May here. And when looking at it from this perspective, structure falling highs and falling lows, you can take this progression and you can just duplicate this and project the target then down at around 140. I'm sorry, 164, 164.20, 164.30 around here on the downside. So there's, based on that projection, there's potentially more pressure to be expected to come here. But what's probably even more interesting now is what could be a positive driver for the CAD, beside the fact that there's now a seasonal trading pattern developing, which I want to show you a little later on, or in a few seconds then in this case. There's further very interesting developments in the economic calendar next week. So today, first of all, there's balance of trade. Not sure whether this is really a high impact news event, but what's more interesting is here, next week we have the PMIs, IV PMIs in this case. So this is giving a very good indication of how well is the Canadian economy in this case doing. But also on Friday, there is the non-farm payroll situation in Canada then. So both numbers, if they come in better than expected, would support the quite hawkish outlook the Bank of Canada gave here several weeks ago with Stephen Paulos. And I want to show you a chart here. This is from an analyst at Daily FX, in fact. So it's John Kickleiter, a guy I follow on Twitter. And I find this chart to be really, really interesting because it shows the probability of a 25 basis point rate hike by end of 2018. And when looking here, you can see that the Fed obviously is expected to at least hike rates at minimum once. You can also double check this here in the Fed Watch tool. So this is for December. This is in fact what we're talking about today also for the non-farm payrolls. If numbers come in below expectation, this expectation around the rate hike in December could drop. And if it drops, this is usually then weighing more heavily on US dollar, respectively, meaning we won't break above 95, 95.30 here. But this is then even more interesting in this context. You can see here a probability of a rate hike. This is the current level, rate level, around 75 to 200 basis points. We are expected to the Fed to hike rates here by 94% nearly. So it's a done deal if you want. So we're more talking about when if there will be a second rate hike. And this is also something which is nearly fully priced in here within this chart. But now the other lines, the green one, this is Bank of England. They did the job yesterday already because this chart, in fact, is from Wednesday. That's something I have to add here. But now look at this yellow line. Who's the yellow line? This is the Bank of Canada, and it's rising. So we are significantly pushing higher. Currently seeing a probability here of over 70% that the Bank of Canada will hike rates at least once within the next 6 months. And with this in mind, I think the seasonal pattern in GBP CAD becomes even more interesting because the pound sterling already tipped its hand here because it showed that it can profit from a rate hike from the Bank of England, while the Canadian dollar can still profit from such a rate hike, or at least speculation. So there won't be a rate hike next week because there's no a meeting of the central bank, of the Canadian central bank. But nevertheless, if numbers come in better than expected, it could drive GBP CAD significantly lower and accelerate this push here down towards 164, 64.20, the projected target on the downside. So with this in mind, I'd like to, one second, please. I have to copy paste it here from another screen. One sec, I have it here. And I want to open another document. So Word document, and then I can easily work with bigger letters here. So a little low, a little small. Let's go here to 14. Perfect. So over the last 23 years, within this time span, 7th of August, this is next week, Tuesday, till the 13th of August, over the last 23 years, in 19 years, or 83%, this is also something we could refer to as the hit rate. The hit rate of 83%, it showed that GBP traded lower with an average gain of 187 pips and an average loss of 79 pips and a maximum loss within this time span. Probably let's do it that way. Probably better. So make long thing short, this seasonal pattern becomes even more interesting now. So from a technical perspective, there has been a break below this level, okay? But it's not only the technical break, which is clearly bearish for GBP CAD and favors the short side, but also the fundamental side. Pound sterling lost, even though there was a rate hike yesterday, and even though the statement, all in all, when carefully looking at it, was or had a clear hawkish stance. Pound sterling wasn't capable of profiting from it, meaning that GBP seems to be definitely, or should be considered, weak currently. And if we add on top of that, that the Canadian central bank, the Bank of Canada, is expected to hike rates by 25 basis points by the end of the year, with a certainty of more than 70%. This also favors Canadian dollar, especially if numbers come in better than expected. And then we add this to this seasonal pattern, and we get a quite interesting trading setup for this period from Tuesday onwards. So how would the trade would be set up? In fact, very simple, and with no big, yeah, let's call it with no big thinking behind it. In fact, you just go short the closing price, or respectively the opening price, from the 8th of August onwards. In fact, you can also show, even though the probability is slightly lower than that, you can show that it starts on the 6th of August. We don't want to overcomplicate things here, but you can also start, I think, with a positive expectancy to short the first tick on the 7th of August. Then working with a stop. This is a little tricky because you just do not know where to place the stop. In this case, it seems a quite volatile currency pair. But when, for example, working with the average to range, let me just see, is it here? Yes. So for the last 14 periods, you can see that here on a daily chart, it was 106. So I think we get the job done with a stop of 200 to 250 pips. Risk in this case, placing from the entry price the stop 200 to 250 pips away. We are also within this average loss and the maximum loss here, by the way. And yeah, then close the trade on the 13th of August, in this case, then the week after that on Monday. We will, by the way, have a look here at how this trades develops, this trading idea develops then within the next trading week, respectively next week on Friday. We have already a very good idea of whether the trade worked out or not. And yeah, so with this, in fact, I'll close this presentation then from my end. I hope that you enjoyed it. And yeah, that's it from my end. So 45 minutes to go till the non-farm payrolls. I wish you all the best. Happy trading. Watch your stops. and talk to you again then on next week on Friday at 1 p.m. German time, so 12 p.m. London. We also, where you have the chance to also follow these thoughts I presented here in written form on Monday on the website from Admiral Markets. There you go then via analytics on Traders Block and have a chance to not only listen to my ideas here once again. There's something here, you can see it. Weekly market outlook, that was is the example from last week. Some of the thoughts were presented here already, or again, meaning that you have a good chance then to reread it again. Yeah, if you're more the reader guy, the reading learner, so there are different learning types. I mean, some like to watch videos, some like to read. There are plenty of chances and resources Admiral Markets is offering. Feel free to reach out to the website and check it out there. And that's it from mine. So I wish you all the best. Happy trading. Watch your stops. Have a nice weekend. Enjoy yourself. Talk to you again then next week on Friday. I look forward to it. See you and bye-bye.